and you may find yourself in a new loan partnership.
All right, all right. Welcome, everyone. Welcome to another exciting webinar. As always, my name is Alex. I am the host here. Alongside myself, we have our senior director, Tim Rowan, and
Howdy,
we
howdy, howdy,
also
howdy.
Tim's traveling a little bit here, which is kind of fun. Our wholesale manager, Scott Cart. Say hi, Scott.
How's
And our
everybody
sales
doing today?
associates, Mike and Lando. How we doing, gentlemen?
What is up, Alex?
Not much. I realize I'm now suddenly in the dark. I think the clouds kind of came over me a little bit when it comes to my window, but we have a very, very exciting topic today. We are going to be talking all about first lien HELOCs. We're going to be talking about rate discounts from them. I'm going to be showing a new workflow that we added last week when it comes to it. All sorts of different things when it comes through this, but really, star of the show here, Tim. How's traveling? How's life?
Well, first of all, it's good, Alex. It's good, and we're busier. Actually, it's really interesting. Just so everyone knows, uh, the opportunity continues to be real. I mean, still, the volume in this process and product team, you know the deal because you're working our inboxes and meeting with so many of our partners and sales teams. But this is going to be a fun topic today, and it's interesting. I just finished another on-site meeting with one of our partners and had a very similar conversation to what we want to have today. By the way, just to set some ground rules, we always love scheduling, having time during this webinar to make sure that we have time for Q&A. So we'll monitor that. Mike, Lando, Scott, just kind of keep an eye on the Q&A session. We'll get to all of that at the end. But I'm thrilled about this topic regarding HELOCs and what about a HELOC in a first lien position. But one of the things I'm most excited about is the team as a whole, and particularly Mike and Lando and Scott. You're going to have a lot, I think, to add to this. Especially Lando and Scott on the team, like myself, come from the MLO, loan originator, mortgage advisor world. And so I'll want you guys to certainly chime in and think of any use cases or whatnot that maybe I don't cover. But at a high level, I want to start by saying this. I want to encourage everybody to maybe change the way we think, what our brain does when we hear the term HELOC. Because what concerns me, and of course people can put in chat or comment or whatever the case is, but what concerns me, having been an originator myself, is that so many originators hear the term HELOC and only think second lien, third lien, only to pay off debts or get somebody cash they need right now to buy another property. And all those things are true. I don't want to dispel that. However, what I want to encourage everybody to think is first think process and strategy for this product as a whole. And yes, that includes being in first lien position. I feel so strongly about this because if I'm working with a client and I don't, all of you are now our client. And so I'm not actively originating loans anymore. But our system from an inquiry perspective is so fast to find out what offer a borrower might get in almost any scenario. I'll take it as far as to say you're speaking with a borrower and they bought their house 3 years ago and they're north of 7.5% on their loan and they need to do a rate and term. Cool. You can save them some money on doing the rate and term. However, you could also try running an inquiry on said borrower and you might be surprised depending on FICO, LTV, certainly non-owner occupied properties because of all the loan level price adjustments. So I want to encourage everybody to think of not just HELOC as only a second lien position, but truly as a strategy for a lot of different scenarios. And as we talk through this, and Alex, I'm going to pull up, I did put it together some mortgage coach information comparing.
Fantastic.
So I mentioned non-owner a minute ago. Now, I'm certainly not the data king here. I'm not the one reporting some of this different data, but I want to say, Lando, Scott, Mike, keep me honest here. What was the number that we heard? Was it a percentage of homes that are owned free and clear? It's
Up
do any of
there.
your
65%? I don't know. It was up there, Tim.
I want to say it was like
More than
40, was it 40
40
million
something
homeowners?
percent.
it might have been in the millions of homes that were owned free and clear. Anyway, don't hold us to any of these numbers we're throwing around. But the point is this: if you have a borrower, and I'm going to lean heavily on this in that non-owner occupied space, if you have a borrower that happens to own a property free and clear, yet they have a need for cash, maybe it's to buy additional investment properties or pay off debt or rehab the property, whatever the case is, I want to encourage you all to, again, set the phrase HELOC out of your mind for a minute and go in and run an inquiry, because, and compare that to what a cash out non-owner occupied transaction would look like. Now, Lando, you pulled up some pricing for me earlier today, and we used a 70% LTV number, and the interest rate, no discount, no
Right.
rebate, par pricing, right?
100% par. Yeah. If not closest to zero, no points. So slightly above par, even if it had to be, right?
Right. And that rate was brinking off of 7%. If I remember right, it came in at 6.875. And what's interesting, everybody, is in our first lien position, that same transaction could be anywhere between the high sixes, honestly, depending on credit score and whatnot. And in fact, I used a 740 credit score on our end, and I'll demonstrate this here in a minute. But the interest rate on non-owner was 7.3. Now, that sounds like, oh my gosh, well, why would I do that? Why would I use your product in first lien position on a non-owner and the interest rate's 3/8 higher or a half higher? The answer, team, is speed to need, and don't forget to include closing costs. Remember that a traditional loan has a lot of costs associated with it, right? Admin, processing, maybe an underwriting fee, tax service fee, escrow, title, on and on and on. And it adds up very, very quickly. Whereas ours has the origination fee that you and the borrower navigate. And for the most part, that's it. And when I say for the most part, there could be notary, right? If it's an in-person notary scheduled. So I want you to think about this not from just an interest rate perspective, but an overall strategy that also includes closing costs and in first lien position. The other part that I want to talk about here a little bit is, if we think that a borrower, let's say they bought their house 3 years ago and they're north of 7.5%, and you're doing a rate and term for them, okay, makes sense. You can take them down to probably 5.875, 6%, given the right borrower and LTV and whatnot. Okay, fine. That makes total sense. But again, I want to encourage you to at least run the scenarios one comparison to another. And I'm going to add another caveat to this here. And Lando and Scott, this will really hit home for you. One of the issues we have created in our industry, if you will, between compliance and all the aspects behind the scenes and capital market and everything, one of the things we've created for ourselves in our industry is a real issue, making it very tough to do lower loan amounts. Is that a fair statement, Lando?
Yeah, I mean, absolutely, right? The smaller the loan amount, then you become, I mean, depending on the state and the things like that, you're going to have, your APOR violations and things that you run into all the time on those items when they start to get to that certain situation. Like I can think of Pennsylvania at the 3% cap rate right away.
Yeah.
There's a lot of times that you're just dead in the water. You can't do anything at this smaller amount and they're done.
Yeah. Yeah, go
And
ahead, Scott.
and you're still putting in the same amount of work for a $60,000 loan using the same resources, underwriters, processors, closers, post closers.
Yep.
It's still costing you the same. It's still costing you the same.
Yeah, and by the way, I think 60,001, Scott, you're not wrong, and in fact, you're spot on. But I would challenge that high cost limits the APOR issue that Lando brought up. And we don't need to get too deep in the weeds on compliance, but I will tell you that running some numbers, I think that really becomes any loan amount of, let's say, 175 or lower, certainly that 125 bucket. And what happens, everybody? And I'd love to get feedback from anyone that wants to put stuff in the chat. But what typically happens is, as loan originators, we do not want to not service that borrower. So we end up going to our managers. We ask for concessions. We ask to do this and we do this. And at the end of the day, folks, what we really end up doing is paying to close a loan. You know what I mean? When you take all of the things associated and just to make it match or comply with all of those high cost things. So there's numerous reasons here why I love thinking of our product outside of just a HELOC. So, yes, our product is a HELOC, but I want to make sure we discuss why. Full draw at close, fixed, fully amortizing is our core product. We do have an adjustable rate as well, but fixed and fully amortizing, full draw at close. However, it's considered a HELOC because it's open-ended on the back half of this thing with a redraw feature. A traditional first lien mortgage agency loan is typically what? Fixed and fully amortizing. Okay, so that's why I say I want to encourage everyone, don't just get stuck on the term HELOC thinking it's only seconds and thirds and, just to pay off debts or buy another house. There's bigger and better strategies and use cases for this. And by the way, we continue to improve the process, which Alex, I'm going to have you demonstrate that. But think loan amounts, low loan amounts, this could be an excellent solution for. Certainly non-owner occupied. And in all of these cases, speed to need is the way I'll say it as well. Listen, we've had a lot of great phone conversations and meetings with partners and their sales teams that as we have this discussion, it's like almost like a light bulb moment, like, oh my gosh, I never really thought of that. And I get it, but that's why we wanted to discuss this today on that. Mike, you're meeting with a lot of our partners and sales teams and having this conversation. What sort of feedback are you getting so far when we talk about this?
Yeah, I mean, it's some of the things that we've talked about, right? Like our borrowers that have those those low interest rates for their first mortgages that they don't want to get rid of, this is a way to kind of get around that. And it's not replacing that rate with a higher rate. It's actually protecting their first mortgage and allowing them to get the funds that they need in more of like a tactical surgical solution as opposed to just like a full-on reset and writing an entire new refinance mortgage there.
Yeah, it's interesting. I was just talking to, again, I had a meeting with one of our partners here. I'm in North Carolina today, everybody. And by the way, the entire team was here with me until yesterday. So they all finally got home. In fact, our partner, Scott here, Scott, what time did they end up flying you out of there? Midnight last night?
Jeez.
We were on the runway for at least 2 hours.
Oh.
For a 1 hour flight, it was supposed to leave at 6:20. I ended up back at my house 2:30 in the morning. So fill in the blanks. Yeah.
Yeah.
Welcome to Newark, everybody.
Yeah, right. So anyway, we did have a great meetings while we were here. But anyway, nonetheless, the meeting that I just had with their partners around this same topic, exactly with what Mike was just saying. When a client, and they're working with different clients, when a client has a cash out need, even though you might be able to drop their rate from drop their rate from an interest perspective from where they are. If they bought their house, let's say 3 years ago, and they're north of 7.5%, you can do that rate and term all day long again and probably save them money. However, you can also look at paying off that existing lien with a new first lien with our product. And the benefit there is you will be able to, assuming they qualify and you get the offers, you'll be able to get them their cash needs. Whereas if you do cash out on that transaction, that runs the rate right back up because of the loan level price adjustment. So we have done some things in Lead Portal, kind of some workflows. Alex, and do you have that up? And
Oh yeah. Oh
walk
yeah.
through that?
Absolutely, folks. So let's go ahead and take a look at this. This was added like a week ago, maybe 2 weeks ago. It's a very new addition. This is something where the ability to pay off, let me be clear, the ability to pay off first is not new. We are just adding in a new workflow for clarity. So let me show that. So we are going to go here into my lead portal. Let's take a look at this, right? And I want to go ahead and run an inquiry for my borrower. So I go ahead, I click on my inquiry. It's not a full training, so I'm going to skip ahead in my little software here. So we're going to go ahead and enter the information. This is a primary property for someone in California. I'm going to go ahead and enter their information, put in their financial information, and certify permission for soft credit pull. Great, right? So we're going to go ahead. It's going to do that AVM. It's going to look at property data. And then once we confirm that, what it's going to do is it's going to identify if there's any kind of promotional discounts as well. So with that, we are going to give that promotional discount Tim was talking about, where it comes to about 25 bips, right? APR down discount when it comes to paying off the first mortgage. So if the borrower can pay off their first mortgage, it will show this as the availability to. And they're going to have two different options. They can either pay off the first to get that discount, but that's not with that cash out option, right? Again, to Tim's point. So if they do want to go ahead and get cash for other goals, right, and things of that nature, that's where they can continue that offer, but they're not going to go ahead and get that rate discount. Now, Mike and Lando, you are helping everyone pretty much every day as experts on the product. Have you gotten any questions about this page in the last 2 weeks or about this workflow out of curiosity?
Not yet. I think it's
Not,
pretty
no,
brand new. So,
yeah, not
That's
that deal. So,
that's how new this is, folks. That's how
and
new it is.
and
It's
also, I mean, I think it's a lot more intuitive as well. So I'm believing the questions are actually going to decrease overall. So
I love that point. I love that point. That's exactly why we're doing this, right? Because again, to Mike's point, this is not new. We have been doing this for a bit. This page is new, right? So let's say we're going, okay, I want to see what that what kind of rate discount would be for my borrower. So we'll pay off that first mortgage. Great, awesome. They can pay off that first mortgage, but notice we do not have a field to go ahead and get cash for our borrower. We're simply paying off that first $100,000, nice and easy for the math. We're going to get the rate discount, and you're going to have, again, that origination fee selection, which is very fun to me. To Tim's point, this is our one fee, our only fee that they don't pay out of pocket. So you can play around with it, see how it affects their rate, play around. But let's say, for example, you want to go back and you're like, well, let's see what it would be like because my borrower does want cash, right? Maybe they want to do something else. What you can do up here, you're going to see this little selection to do updated cash amount. So we'll go ahead and click on that. It's going to say, hey, you can do that. It's just going to go ahead and not apply that discount to the rate. Perfectly fine. This is something where it's going to then give you that availability to then do that cash out for your borrower. So in this case, now they can do cash out, a whole bunch of cash out for this borrower. So we'll make the math easy. We'll say the borrower wants $100,000. We'll go with the higher origination fee to get them the lower rate. We're going to go ahead with a fixed rate. But what I want to show you is we go ahead and select the rate. Well, we're still going to have IntelliDebt. We're still going to have direct debt payoff. So if we do that, we go ahead and get started. Well, if we take a look, that first mortgage, that Chase mortgage, that's still there as an availability to pay off. This is just giving them the ability to take cash out. Thus, they can also pay off other debts if they want to. So it's really important, I think, to know what the borrower's goals are and what's important to them. If they just want to pay off that first, right, as a option, get that discount. This is a really good option for it. But maybe you're going to have that borrower who wants cash out or that borrower who wants to pay off all those debts. That's where you can then go ahead and make these selections. So let's say we did want to pay off that first and we did want cash out. That's still an option, right? So $200,000, 100 to the borrower, 100 to pay off that Chase mortgage nice and clean. And then we'll go ahead and get that through. But we're just simply not getting that discount, but we're still getting that discount for auto pay. So at least they're going to get an easy discount built in. Anything you guys want to add on to this at all?
Alex, are you in, I assume you're in our presentation deck, like
Oh,
how to
yeah,
go, you're
correct.
not actually in test, is that right?
Oh, yes, absolutely.
Okay,
Is
I
that
just
something you want
wondered,
to show?
well, I just wondered what the rates were coming up there. I went and did the good old fashioned, took a look at rate sheets this morning, but this is probably not live pricing, so that's fine.
This is not live pricing, folks. I do want to let you know. So,
By
like
the
when
way,
we're
it's
selecting
pretty
these,
darn close, actually, Alex.
I did
Yeah.
make this today, so it is today, but I can't guarantee that the rates that they put in for a test environment reflect
Yeah,
folks.
no,
But
that's actually really, really close. That's interesting.
Yeah, I would
Very
just
um,
interesting.
want to also point out that LLC is a ownership type for this product, which is really important for investment properties.
Yeah, no question. On investment.
Yeah, yeah,
LLC
yeah, on
vesting.
investment. Yep.
Yeah.
over here for ownership, LLC. Look at that, brand new. So if you folks haven't seen, that was added what a month ago or something, Scott. It was pretty recent.
Yeah,
So
about that.
but that's going to be that new workflow for it. We do have a workflow as well that we're improving when it comes to win back. So if they need to pay off that lien in order to get offers, we also have a win back path. I'm going to be adding a whole bunch of information in the resource center, documents, demo videos, all sorts of fun stuff. So you'll see. Keep in mind, folks, I will be sending out an email after this webinar that is going to have information on this. I'll send out a recording of all this and all of that and more. So we're going to be adding more and more in there. But that was from feedback from you all, just for better clarity for those savings. And to Tim's point, think of it more as a traditional HELOC. But hey, let's go ahead and take a look at mortgage, coach here.
Hey, look at that, right? I told you I'd get it done, Alex.
You made a promise, and Tim Rowan always keeps our promises.
Well, we try. Listen, folks, this is just at a high level. I did this very, very quickly, but the pricing is going to be pretty accurate. I didn't go in and run inquiries in our system like what Alex did earlier this morning. So, Alex, your rates are actually a little bit better than mine. In this case. So I was just doing it off of generic rate sheets, and we all know how that goes. So what I want to point out here is these first two columns on the left. I'm saying property value 250,000. I'm trying to just force a 70% LTV type of thing. And what I thought was interesting is a cash out refi, and Lando, jump in here as well. But Lando priced this out for me this morning. Again, you mentioned par pricing, so on and so forth. Lender paid comp, just like our product, but par pricing. Just confirm. Yes?
Yep. Yep.
Okay, so 6.5%. Well, then you look at a first lien HELOC and you go, well, shoot, that's a 0.5% higher. Well, that doesn't make any sense. Why would I do that? But I want to go back to what Alex just demonstrated. Alex demonstrated that exact scenario basically with maybe a difference in loan amounts. And here's the difference. Also, price. Remember, we're going to be doing cash out on this transaction, and we can close it considerably faster, okay? And with typically slightly less cost. Now, I'm not reflecting that here, so for that, I'll have to modify the report. And Alex, I'll modify the report so that we can include it. You know what I mean?
Oh, that'll be
As
fantastic, and
the
I'll send that
follow-up
in
of
an
the webinar.
email. Mm-hmm.
But as well, I want to point out the traditional cash out refi and non-owner occupied. Lando also priced this out for me as well. 6.875 versus our first lien HELOC and non-owner 7.35. Now I went on the high end there because I will tell you, we do have that on our rate sheet in the sixes, 6.7, 6.8 in that range. So the real message here is one, there's very little difference one versus the other. So what does become a game changer is in fact loan costs and time to close, right? Think of this as an overall picture of drain on your resources, whether it's your processors, underwriters, Dr. R's, whatever the case might be. But think of it from a perspective of at least going in and running an inquiry, even if they're going to be doing a first lien transaction. And even though I'm not showing it here, think about what happens to this if it's a $125,000 loan amount. The costs, well, one, there's a lot of, Lando, keep me honest here, or maybe Scott, either one of you. $125,000 loan amount, Scott, in your previous role, what would that have looked like for your sales team?
I always threw on 3.5 to 4% closing costs off the top of my head.
Yeah. Exactly. 3.5.
That range.
Yep.
Yeah.
I would say 3.5% is about spot on with credit reports once you get into everything else. Yep. Amen.
Yeah. And then when you did that, what would happen? How did you deal with the high cost loan concern or the APOR stuff?
Well, I mean, yeah. There's only so
Go
much
back to the
you
loan
can do.
officer. We have a problem, Houston.
Right. I mean, in most cases, Tim, what it really happened is you had to go back to the LO, you had to reduce compensation they were making to drive the rate down to add initiatives, right? So you're starting to lose comp buckets. Or, if you're coming from the IMB world, you've got to look at a different servicer that's going to now take your book of business because they're targeting this one specific demographic. And now we all know what happens. The moment's rate drop in 6 months, 7 months, 8 months, they're blowing your customer up that's in your pipeline, but that's who they're making their payment to, right? Their speed to response is giving them the edge when you fall into those niche small markets where you're limited on who you can place the loan with.
Very cool. So while we're talking about this, and I stopped sharing my screen, but I'm just kind of curious, you guys are using a 4% cost. Is that what you said?
3.5 to 4 is about right.
Okay. So let's just play it. Let's just have some fun, everybody. Let's see. Let me use some more real-time numbers here. $175,000 loan, Lando. Tell me what you think the total closing costs are going to be on it.
So if you're at 175, yeah. So I mean, realistically, once you add in title, you add in your escrow, you're probably looking somewhere in the neighborhood of, I would say 5,500 to $6,000.
Okay, so right now I'm at 35, 45. I'm at 47.50. So I'll add another $1,000, right?
Yeah. I mean, just, and then you go, yeah.
So we'll just, again, just trying to keep everything apples to apples and all the comparisons the same. So I'll just do the same here. I was close, actually. Give T Row a little credit here. I was a little low, maybe, but nonetheless close. And let me come over here and then refresh this page. Let me get rid of this silly little video. Let me share my screen again. And take it.
I know where you're going with this, Tim.
Yeah, I was just checking to see if
The anticipation is killing me.
right? Yeah. Well, I just was trying to see. I think I need to do it on the. Actually, I don't mind sharing this. While I can share my screen while I do this. You guys can all see how I work. If I can just find my share screen.
Are we looking at the recoup period, Tim?
Well, I was going to look at the recoup period, and I was also going to look at what it does to the cash out. But you're just going to be adding the closing cost of the loan, so the loan amount
Right.
ends up being higher.
Right. I mean, you're probably at about 46 months to recuperate those costs and the difference of the price. Right. If you're looking at a $120 difference in the pricing scenario you ran, you're at a 46-month period to recuperate those costs.
Right.
And I think the big thing on it, Tim, too, is to think about especially when it comes from the non-owner occupied, if that's rented, you're not paying the interest.
Right.
Right. If it cash flows, you're not paying the interest. You're getting equity out that you can use for a different entity quickly and immediately, which, that could be to increase your overall rental portfolio by obtaining a new property, which is going to build more generational wealth than dropping your interest rate, right? Two properties is going to pay you more in the long run than one property.
Right.
So I think there's a lot of that information. And the one thing while you're doing this, Tim, I think that they should think about is the massive difference in our guidelines versus your Fannie
Oh.
Mae and your Freddie and your traditional
Oh.
guidelines as to what you have to provide, the documentation, the scrutiny as to what they're looking at, ordering a 1007, looking deep into tax returns, all of those things, condos, those types of things when it's an investment property, you're eliminating all of those hurdles.
Yeah, no condo questionnaires, which is, you mentioned condos. Good luck trying to get a condo questionnaire on half these Florida
Well,
properties,
and now you're at
etc.
yeah, now you're adding an additional fee you have to pay to have the condo questionnaire completed 90%
Yeah,
of the time.
yeah.
Exactly. It's funny. I was
Look,
just doing a webinar on
if
that
you
topic
take our
too.
fixed HELOC, right, and you never take a draw on it, it's a fixed product. Same exact thing. That has some nice features on it where it can re-amortize if you pay it down a bunch. We'll talk about that later. But when the boiler goes in 3 years, you want to throw 15 grand on your credit card, or you want to just go to your HELOC on that property. Guess what? Stuff happens. And I don't say stuff, I'm meaning another word, but stuff happens, right? And you need money, hole in the roof. What did your tenants do? Hole in the wall. I need, a couple grand to fix this, fix that. It happens.
Yeah, it's such a great point. And of course we said at the top of the hour where we talked about, right, our core product is of course fixed and fully amortizing. Most agency loans are fixed and fully amortizing, or even adjustable rate and fully amortizing. So side by side comparisons. But Scott, to your point, ours, because it's open-ended, therefore categorizing it as a HELOC, opens up tons of opportunities. And by the way, just to be clear, everybody, recasting is one of them. Anytime a borrower in our product makes a 10% or more principal reduction payment, the payment will automatically recast down to the balance owed. Your traditional loan will not do that.
Right. So I think that's a huge point, Tim, right? What do you have to do if you recast? You have to contact your servicer. You have to pay a fee. You have to fill out forms. Then you have to deposit it. There's a cost that's going to be associated with it. And most of the time, it's a 60 to 90 day process. that you
Mhm.
have to go through before you actually see that file recast. And it can be anywhere from $200 to $500 out of pocket every time you want to do that.
It's
Yeah.
also typically a one-time thing too.
Right, absolutely.
Oh, that's a great point, Mr. Mike Orlando. I didn't actually think about that, but you're right. In a traditional world,
Former loan servicing manager, so
so you're like, yeah, we'll do a
that info
recast
came in handy
one
one of these
time.
days.
Yeah, that is
And
funny.
this actually bridges over to we have an anonymous person asking a question here in the chat, basically saying, "Hey, does your product have like a debit credit card, like automatic deposits in the paycheck for the HELOC, that kind of thing?" This to me is a really big thing. They're going to have an online account. They can do redraw as much as they want within their draw period, right? There's no prepayment penalties, no fees for redraws. It's not like the old days of the HELOC, right, where they would get a little card and they could use that. No, they'll have an online account. And to Scott's point, these can be fixed rates. So there's a lot of power here to use, especially in my example. They paid off their Chase mortgage. They got $100,000. Awesome, great, right? That's just the start, though. It's principal plus interest payments. It's a fully amortized loan. They're paying that down. Great. Maybe 2 years down the road, something happens. They just log into their online account and say, "Hey, I want an extra 10 grand." So there's a lot of strategy here, but it's also peace of mind for your borrower. It's not just their need today, it's their need down the road, in my mind.
Yeah, I agreed 100%. So I think the one word that sums that up is the flexibility.
Yes,
And
yes.
Mike, you made a great point, and thank you for bringing that up, Mike. I was
Mhm.
actually not aware of that, if I'm being honest. And I've been doing this a long time. I did not realize that typically servicing will allow a one-time recast. That's interesting. And by the way, we have Alex, keep me honest here, but we have zero cap on how many subsequent draws can be done in any one given time, and zero cap regarding any recast. If I paid 11% down next month after getting my HELOC, my payment would go down. And if 6 months later I paid another
Mhm.
10% down, my payment would go down again.
Mhm.
Yeah. So without even having to contact a guy like Mike Orlando in the servicing department.
To be clear, I'm not in the servicing
Yeah.
department. Please don't ask me those questions.
Yeah, we got him on the spot now. Now he's backing out. Look at that.
I shouldn't have said anything.
Oh, it's all good.
I
It's
think
all
the
good.
the one thing too, Tim, from a standpoint is that looking at how we service our product versus how other people service their product, right? The value in servicing is to sell your book of business or have a new clientele that you can actively market and go after, which means
Mhm.
when those things are being sold, your client is being solicited by your competition.
Yep.
And let's be honest, a lot of those
Great
services are
point.
exactly what? They're going to be a call center with incredibly low margins that are going to just be quantity over quality, and that's who's bombarding your client, right? That's not our model, right? So it's that protection of your relationship.
Yeah, I agree with that 100%,
Wow.
Lando. In fact, as you know, as a team, we discuss this with our partners all the time, and that is one of the things that oftentimes folks tend to overlook in the industry is what an incredible retention tool our product is, meaning second lien position, first lien, third lien, you name it, it doesn't matter. It's a retention tool, team. If I now am taking care of that client versus sending
Mhm.
them off somewhere else to a bank or a credit union where guaranteed they will definitely do what Lando's trying to do, even in a HELOC position, try and retain that client at a much larger level. And they have massive budgets, massive marketing teams. you know,
Mhm.
they're a machine when it comes to that stuff. So whether it's in first lane, second, or third, it doesn't matter. I want to encourage you, Orlando. It's a great point that think of it as another strategy, and also think of it from a retention strategy. Because just to be clear, we do not market to any of your
Mhm.
existing figure HELOC clients. We just don't do it. Do you have any more questions in there, team?
There's a couple ones, Tim. We've got one about are we able to do first, second, or third HELOCs in Hawaii?
Ooh, uh, ooh. Alex. Well,
Here's the response to that is check internally. The reason being is that Figure does not, but that's through our DTC, right? When we're talking partnerships, so for you, for example, that depends on your licensing. That depends on the licensing if you're under a broker, if you're under one of our
You,
private labels, right? So there's a bit of a nuance there, but I would say check internally just on
you
what you
have
all
to
have
have
for
you
licensing.
have to have brick and mortar on the ground in Hawaii to be able to
Correct.
offer financing. That's the one
Correct.
thing that happens with Hawaii from a lending standpoint. The company
Mhm.
has to have brick and mortar on the ground.
And another point to that too is it does mention if it's in an LLC, which would lead you to believe that it's an investment property, so we wouldn't do a third anyhow.
Right.
Right.
Second, yes.
You
First,
guys,
yes.
you guys are experts. This is great. Folks,
Yeah.
keep in
By the
mind,
way, I
sales
might.
success at figure.com. You're going to be talking to one of these two. They know
Hey,
everything about everything
Tim,
when it
I'll
comes to it.
volunteer to be our brick and mortar in Hawaii if you need any
Well,
help.
no, no, no.
I'll
That's what I
raise my
wanted
hand.
that's what I wanted to clarify and get you guys all up to speed. I've actually recently learned that we have just obtained brick and mortar in Hawaii, and I've already lobbied saying the sales success team certainly needs to make a trip out there
Wow.
for an on-site team building event. So
There we go. There
We
we
have a lot to
go.
talk about. So what, 3, 4 weeks, right? Something like that.
yeah,
Yeah.
yeah, yeah, yeah. Like once a month, we're gonna have to go to Hawaii. Wouldn't
Yeah.
that be great? Yeah, but just to clarify a little bit, just bit for the who asked the question, we have partners that have brick and mortar in Hawaii. They are approved in Hawaii, and as a result, they can use our product and process in Hawaii. So just to Alex's point, check internally in that. And then, of course, we should in short order be there ourselves as well across the board. So
It's good to know.
any other questions?
We've got a
Yeah.
lot. I can read through them. I've got them pulled
Yeah,
up.
let's go for it,
So
Brenda.
is there a DSCR feature for a owner occupied property?
So we have just rolled out a DSCR feature, and actually, we're going to pick on Mr. Scott Karch here for a little bit. So again, depending on who you're with, as partnered up with us, we do have a DSCR product. It is not a HELOC product. It is a rate and term and or cash out fixed product, and we're getting there. I'll be honest with you, we're learning some things about DSCR. So if you're wondering if you're signed up for DSCR, if you are with a broker shop, let's say that's approved with us, and you think you all want to get signed up with us, you can email us at salessuccess@figure.com and make the request. Scott Karch, for the most part, handles getting any new contracts in place and that type of thing. But yes, we have it, and you know, it will get better. Let me say it that way. And yes, we do them in LLCs.
And I
Yeah.
want to add on to this that we have done webinars in the past on DSCR. So if you are interested, the email I send out is going to have a link to our YouTube. You can go back to previous webinars that we did about DSCR. And then again, contact us. Scott's the master of DSCR at this point.
He's going to throw something at you.
Our next question was around comp. Can we choose either borrower paid or lender paid, or do we have to set comp up with you?
It's a great question. Right now, we are solely lender paid, and when someone comes on with us as a partner, that's when that is navigated, and we have zero control or visibility. So we know what the comp is going to the partner level. What we have zero visibility into is how partner pays the comp to the LO. But we are all lender paid. And right now, there is no discussion of coming up with an additional option to flip to borrower paid. So right now, it's all lender paid across the board.
Our next one's we just want to confirm figure is a closed-end HELOan and not an open-end HELOC that can be reused over and over again.
I'm glad you
Good
asked the question because it's just opposite of what you're thinking. So it looks, and let me just explain this as best I can. Our product looks and feels very much like a HELOan in the sense that it's fixed, fully amortizing, and full draw at close. However, the reason it's not considered closed end is it has an open-ended subsequent or future redraw feature. So that's why it's categorized as an open-ended HELOC. I want to be clear. It's not closed-ended. It's an open-ended HELOC, and it's because of the redraw functionality.
Outstanding. All right. Do we allow non-occupant co-borrowers for a primary residence where both of the occupants, where both primary residents, where they both occupy the property, or the non-occupant is already on title?
So, um, We only, just to be clear, right out of the gate, we only ever have one borrower on our files, everybody. And this is very, very different from the traditional loan world. So I get it. We have this conversation with our partners all the time. Having said that, there's one borrower on the file. If the subject property happens to be in a community property or homestead state, we allow you to include spousal income, not household income. I want to be clear on this. So if you have spouses, they're on title, they're married, of course, and they're in I'll use California as an example, community property state. One borrower, both incomes stated at point of inquiry, you're stating the annual income for both. You'll want to get into our resource center and you'll want to find that in our product guide, and it's highlighted beautifully. Alex has done a great job listing all of the states. And by the way, it's quite a few of them that are community property or homestead states. The reason I really want to drive in on the spousal income is, Lando, part of that question that was asked is, what if I have a non-occupant borrower? Maybe it's grandma or grandpa. And then I have, grandson or granddaughter living in the property. You do not get to use the non-occupant borrower's income unless for some reason they were married. And then I would wonder, well, I don't know, having your spouse as a non-occupant living somewhere else, I don't know, maybe it's not such a bad gig. But anyway.
Hey, Tim, just to touch on the single borrower, I actually had a call with a loan officer today. It worked out really, really well because the one spouse had quite a bit of debt. They're looking to buy a new property, like a new home, and what they want to do is pay off the one spouse's debt. We were able to run an inquiry on just the other spouse, get that approved because we're only running it on the other spouse's
On
credit.
the borrower, yeah.
Yeah, yeah. So we were able to get enough money for them to not only pay off the spouse's debt because they want to get that other person's credit score up because when they buy the house, they're obviously going to use both
Sure.
people. And so they paid off that debt and had money to put a down payment on the property they were purchasing. So
That's
that's where the only single borrower comes into play, where you're
a
able
great
to use
strategy.
two incomes versus one liability.
And that's big when you said community property state too, because when we hear community property in the standard lending situation, it means depending on the type of loan or where I'm at, like Wisconsin, I have to pull the spouse's debts. I've got to look at all of their things, whether they're on the loan or not. Right now, I know FHA, that's everywhere,
Yeah.
right? But in this case, we're not looking at it through that lens where we care about their debts. We're just saying because they're in this state, we allow you to use their income to qualify. So you're getting the best of both worlds. We're eliminating their debts from the equation where you typically have to take them into consideration, but we're giving you consideration for their income. So different lens, different train of thought from what we think of on our standard lending, standard cash out
Yep.
or, rate and term refis.
Yeah, love it. Next up.
Yeah, is it possible to have payroll direct deposited into a figure HELOC? We have some customers that are asking about using Velocify banking to help accelerate a mortgage.
Not currently. They are linking their bank account to auto pay. However, it's not. I know exactly. By the way, I'm very familiar with that thought process and I love it. But no, we do not have the ability to do that today.
Next one's easy. Can we do an LLC on a primary?
Negative.
Very simple. All right. A couple people is just saying thank you, shouting out that they have access to DSCR already. They want to know, do we have any plans to roll out a DSCR HELOC?
Well, I will share with everybody that is certainly on the table for discussion. But full transparency, we want to first get our current rollout of DSCR working a little bit better. And when I say working a little bit better, team, we're getting ready to enhance some guides. In fact, going into early April. At one example, I'll just give you all one example. Right now, today, our DSCR product does not allow for the cash out of the transaction to be used as reserves. However, we're getting ready to change that. That one step, Scott, would you agree? That one step is going to be significant for us in increasing our pull-through on DSCR.
Oh, absolutely. 100%. Right now, we're looking for 3 months. Some of their own verified. Some require 6 months out there. Not a lot, but some do. So there is some good features built within. But yeah, they have to have the cash out there.
Yeah, and so once we get that rolled out, like I said, early next month, I just saw a thing come across my channel this morning indicating that that was close to going live. That will be a big lift for us. And the truth of the matter is, team, is we're learning all of this stuff from all of you. If I'm being honest, that's where we get our feedback. In fact, Alex, you've been here on this call here of our entire team. You've been here the longest of any of us. You're what, running on 5, 6 years now, Alex? I
6 years now, Tim.
6 years. So, Alex, is it a fair statement to ask you this question? Is our figure HELOC better today than it was 6 years ago?
Tremendously better. 6 years
Okay,
ago, I
so
was doing manual verification of employment, sitting down calling employers over the phone. We don't do that anymore, and things of that nature, right, folks? So it is, I can't wait to see what it's going to be like in 6 more years, Tim.
well, yeah, and that's really to my point. So we're trying some new products, we're rolling some things out, and it's sometimes some of them take us a little bit longer than others, but just know that all of your feedback on this is what's making the changes. So keep the feedback coming, please.
All right. So on the investment part, closing an LLC, they want to know, do I have to be licensed in the state the property is in? As we have investors who buy in multiple states, and with many of our non-QM or DSCR, which is a business purpose loan, let's be honest, I don't
Right.
have to be licensed.
Yes, and yes, you do. And let me, I think we got to clarify that because it really comes down to the partner level, wherever you're at. You know what I mean? Like we have some states that we've broken out in our guides that yes, you need to be licensed. Other states you don't need to be licensed. However, that doesn't mean that whoever you're with isn't going to require you to have a license. Scott, is that a fair statement?
It's a very fair statement, yes.
Yeah, so those are some of the things we're working through right now. And if you already have DSCR turned on with us, you'll know, by the way, because when you go to click Create New for the inquiry, DSCR would be an option. You'll also know if you go to our resource center and you're able to click on DSCR product guide, that will be live for you if in fact you're active with it.
I think the other thing to think about too is, Tim, there's a big delineation in the difference between doing a home equity loan and doing a DSCR loan,
Oh
right?
yeah,
While we can close in an LLC, the grantor, it's still going on the individual's credit, right? DSCR is a little different as a business purpose loan and those types of things. So there's a big delineation in licensing with what's required with the HELOC process versus the DSCR.
correct. No, no
Completely
question
different
about it.
channel. All right, Joseph wants to know, how are we verifying income?
Oh man, that's a wide open question. So thank you, Joseph, for answering. And I'm going to give you the right out of the gate Alex Nichols answer here. So Alex mentioned our YouTube channel earlier. And Alex, we have a host of videos actually, but one in particular on our YouTube channel that covers all income verification methods. However, at a high level, the answer is the best path for a borrower to verify income is for them to connect to both their personal and now business bank accounts. Okay, and the borrower does this on their portion of the application once they've clicked the link to accept the offer and whatnot. If that doesn't work for them, we will physically review pay stubs and award letters. Those are the only two documents that we will physically review for income, not W-2s, not tax returns. Having said that, the borrower can also link to tax transcripts. Okay. If that doesn't work for them, if they have the ability to log into a payroll service provider, they could log in there. They can also connect investment and retirement accounts. Think IRAs, 401ks, because our system will calculate asset depletion for them. And are you ready for the best news of all of this? One of your borrowers could literally choose every single method available you're seeing on your screen, and our system will default to whichever is the highest. Okay, so one, get over to that YouTube channel after Alex sends the follow-up and whatnot. We have a full breakdown on some of the tips and tricks on income. It is something we talk about a lot, but that'll be your fastest. Also, if you get in the resource center, click on HELOC, then you'll see income. How is it you have it labeled? Is it
It's income verification guide.
Thank you.
income verification guide? And right there's, I think, 5 videos individually for each of those income verification stages. And by the way, each of those videos are less than a minute long.
Perfect. All right, this is a great one we get all the time. Okay. If they're selling the house, is there an early payoff penalty?
Well, again, there is never any harm or foul to the borrower, just to be clear. Some folks get that confused, so I just want to clarify there's never any harm or foul to the borrower. Right out of the gate, when you're running the inquiry, you're asked a question, is property listed for sale, yes or no? If you choose yes, there will absolutely not be any EPO, but there's also considerably less comp, which you'd want to check internally with your team about. If, however, you don't choose yes, the property gets paid off in the first 16 weeks, then there would be EPO and we would be clawing back the compensation from the partner. However, they handle that with you, again, it's out of our scope of vision.
Perfect. The next question, I'm going to just call out. All right, so it came from Lauren Harvey. I would say that question is something you should email sales success. We'll answer that one off the line. That would be something better that we would want to speak about directly with you on that. And our last thing is that since we're getting some questions on DSCR, we have it. Are we going by the appraisal estimate of rental income?
I'm sorry.
So basically, Tim, they want to know, are we going to go off the lease that we receive or the 1007 that we receive back? What would we use to calculate the 1-to-1 ratio we need to have the DSCR coverage?
We're going to go off the rents. Now, it can't be vacant, by the way. We're going to go off the rents, and then the appraisal is going to get done, and it depends on if there's a percentage variation between that 1007 versus the rents that are being collected, and then there's some calculation there. But initially, as far as generating the offer, we're going to go off of rents.
Right. That's all the questions we had in the Q&A box.
Well, it's just about perfect timing. Team, and anything else you'd all like to jump in and add?
Yeah, I have a question.
Yes,
How
Scott.
long does it take to find out if my borrower can do a HELOC on an investment property?
That's a great
2
question,
minutes.
Scott. We'll go in and do the
2
inquiry, and
minutes.
we'll find out in a minute. I
Yeah.
think Tim's going to make a great video about this around this topic here shortly. So, folks, I'm going to be sending an email with a bunch of information. We're going to include a copy of that mortgage coach report. I'm going to be sending some information about the cost savings reduction off first lien. But more importantly, I'm going to have links to everything. So, our YouTube channel, Sales Success Center, lead portal, and our email for sales success. Feel free to email us, schedule time with us, let us know how we can help, get on branch calls, sales meetings, get in front of your teams, anything of that nature. But with that, I think that's everything we had today, Tim.
Everybody, the opportunity is real. It continues to be. Think strategy versus just thinking HELOC. The fastest path, log in, run an inquiry. To Scott's point, that's your fastest path to finding out if this process and product is a good strategy for your borrower. Start there. Everybody have a great rest of your week. Team, I'll catch up with you later.